Good morning, everybody. Welcome to the Flow Show. Just before we start, you can see I've got the trader coaching screen up there. I just wanted to say thank you to all the people who have booked sessions, be it with me or other people. But personally, I want to say thank you. Some of the people are in this very chat room that we've got here at ForexAnalytix. Some people follow the show but are not in our chat room. And yeah, I just want to say thank you. I've really enjoyed doing the sessions. I hope people have got out of it what they've wanted to do. I am very humble that people who have chosen me for some sessions, it could be a lot of money for people to pay, and that humbles me. And I hope that I and the rest of the team have given good value. And it's not just about doing a session and letting people sail off into the sunset. This is just part of what we want to offer at ForexAnalytix. The whole suite of services and help we can give traders. So whether you take sessions, whether you don't, whether you come to our chat room, whether you don't, whether you just watch these free shows, I want to say thank you to all of you. And I hope that the whole ForexAnalytix team are doing you proud and helping you on your trading journey. I just wanted to say that on a Friday as we end the week. Good morning, K-Man. How's it been for you doing these sessions?
Hey Ryan, hello everybody. Yeah, I'm of course, as you say, humbled by the interest of people having in our team, in everything that we do. No, it's a real pleasure to do those sessions, of course, and helping where we can, and giving the people a little bit of a taste of what is achievable, what we can do, where we can help people who have been in the market for many years. I think we must be well over a century of combined experience in our team. So yeah, for those who are having a bit of an issue with their trading, or even sometimes it's just good enough to refresh, or as I always say, like look at the psychological side of things as well, where we, having been in the market for a long time, we've been there. We've seen. I'm not going to say we've seen it all, but from a personal perspective, I think I've seen quite a bit, having been in the markets for over 40 years. So we can all help you in some, even with the psychological effect of things, not only showing nice pictures, tell you where to buy or sell, which is actually not our aim. We try to give you the rod with which to fish instead of telling you what to do. That's not our aim. But yeah, it's always a great pleasure of doing it. I'm taking pleasure every day to reply to people in our chat rooms when they have a question, trying to show them a perspective that may be a little bit different from others sometimes who are purely technical or so, but it's always a pleasure to help people out. And yeah, of course, we're charging for it. We're giving our time to it. We invest a lot of our time in preparing all those sessions, trying to do it as personal as possible to the person who is interested in it. So it's always it's a great thing to have, of course.
Yeah, thanks, mate. And yeah, totally agree. And you're quite right. We've seen a lot, but the last few years have shown even old hands like us that we haven't seen it all. Pandemics and wars and all sorts. So yeah, every day's a learning day. But yeah.
So that's what I've been saying in the room as well. Even having been before the pandemic struck 35 plus years in the market already. This was a first for me as well. Those accelerated economic cycles. Moves that we haven't been seeing. Only people who have been there in the 70s may have seen such kind of moves on interest rates and things. But yeah, it's a learning curve for everybody. And but the good thing or the one thing I'd like to say is that people with experience will adapt, and the fact that we are still in markets and we're still ongoing means that we can adapt to these kind of situations, and that's what actually we're trying to do, and to help you with to adapt and be ready for unforeseen situations like we are still living right now in a certain way.
Yeah, I think that's a key point as well. For people who haven't been doing this long, every year that passes in front of a screen is you building up the same experience that we have over the years. And it doesn't take long before you get to know how markets work, how they function, and then you're off and running hopefully. And you need less help from us, and you're standing on your own 2 feet, which is what everyone wants to aspire to and the place they want to get to. But right. Okay, let's get stuck into what's going on today before we use all our time up talking about other stuff. I'm going to look at a bit of data from China. This was on my watch list anyway, just seeing further different sectors coming out. We've had CPI, obviously, where they've seen some tepid improvement there. Retail sales came in a little bit of a miss, 2.3%, but still positive. Year-to-date numbers a little bit softer as well. Unemployment looking good, coming down to 5% there. Also had industrial production year on year. They do a lot of year on year numbers, this lot, coming in healthy, 6.7%, beating expectations. Some investment numbers, a bit softer, but still decent amount at 4.2%. House prices, though, year on year, down 3.1%, and they're still fighting tooth and nail to fix that side of the economy, which they are doing, because overnight this morning, the PBOC have scrapped their nationwide minimum mortgage interest rate. And also they've cut down the minimum down payment ratio to 15% for first-time buyers and 25% for people who have second homes. The previous ratios were 20% and 30% respectively. So they're making it easier for people to get in buying homes. They've also asked local government to buy homes and turn them into affordable housing. And the PBOC have set up a new 300 billion yuan re-lending program for cheap housing, and they're giving that, they're putting a rate on that re-lending instrument at 1.75%, so fairly low on that front. So they're moving, they keep moving. We know there's problems with housing over there, but we know they've also got the tools and the money to throw at it to try and get it working again. Let's see what happens. Over at before we get there, they also kicked off their first government bond auction that I spoke about earlier this week or last week. They're doing one of their one-off bond moves. Their first auction saw 3.91 bid to cover, so very, very strong, nearly 4 times the amount of people trying to grab those bonds, which was seen as very strong, and they sold that off at 2.57%. So fairly decent-ish yield, let's say, with inflation that low over there. Over to the BOJ. Ueda was up in Parliament, and he says we must spend some time in deciding what to do with our ETF holdings, including whether to unload them in the future. That was speaking to Parliament, so no signs of any movement yet on them selling their ETFs. Big question mark still over that. The BOJ also left their usual bond buying amounts unchanged from the last operation, which perhaps isn't a bit of a surprise because there's no real stresses in the bond market. Well, maybe Suzuki's seeing some, but there's no real stresses in the bond market at the moment, so no real reason to do that. Kay, you said it was another bit of a shot in the foot, shooting oneself in the foot from Ueda.
Well, yeah, I mean, if you want the market to adopt your plan to hike those interest rates, to get out of it, out of those that zero interest rate thing, he may just be silent on it. Of course, when he's speaking the diet, I mean, there's always a lot of people asking him questions, so it's more than likely just a reply to one of those questions. But every time it takes it takes time, and we are waiting to see what happens, and it always delays the impact, and it shows again that he's not, I mean, in a hurry to do anything. But on the other hand, it's a bit of a loose cannon, because they haven't been buying ETFs for a long time, right? They kept their amounts, but they don't need to buy, because the market is. I think they did something like really stupidly small amount at one stage, but they just don't need to do it, because the equity markets are zooming on, are at much loftier levels now. They don't need to really go and support it. But I mean, if they want the market, and if they want to push the government to fund more of their stuff when yields are still reasonable, he shouldn't be talking about about those things at all, to be honest, and just leave the market guessing. Now, I must say that these JP10s, they are slowly but surely grinding towards that 1% level. We are at 95.5 BPs right now in the 10-year yield, and we're nearly there. We're nearly there. I've seen the government has funded a 20-year that went well. They overpaid just slightly, but it went still relatively okay. Yeah. So for the time being, it's still not. There's still no big change in change coming. But I've seen this other article about an ex-chief economist at the BOJ saying that. He now thinks that June is a possibility. That's what I've been saying as well for another hike, and I guess we are going to get those couple of days before those scuds being sent out in the sea, the messages, or if to see if they become more serious about another hike. I guess we are going to see a bit of speculation on the yield side in Japan going into the next BOJ meeting, which is on the 14th of June. So a small month from now. But in the meantime, there's still a lot of yen to flow through Tokyo Bay.
Yeah, exactly. And just another thing, a lot of people obviously looking at the BOJ's bond holdings and saying, it's if yields rise, then obviously they're going to be sitting on a paper loss and whatever. But surely there's a bit of offset with the ETFs, because they haven't bought them for a while, and stocks have got up a big chunk over the last year. So they should be making a decent buck on the other side of it.
And yeah, their foreign holdings perhaps as well.
Yeah. So
I mean, that's food for economic writers and analysts and stuff.
Yeah.
But when has a country, if it's not an emerging market, an emerging country or a underdeveloped country, when have they defaulted? On their own debt, or when has huge paper losses become a problem? Remember last year when the Swiss was getting stronger against everything, and the equity markets went lower. Everybody was talking about the S&P's losses. What's the issue now? Because all the equity markets are back up, and the Swiss is weakening. So they're reaping enormous profits from it. So, I mean, it's just it's not tradable. That's what I mean. There's no trading.
No, not at all. It's not, and it's not a problem for the central bank. They don't give two monkeys about losses or whatever. Maybe a bit more in Switzerland because the cantons and the shareholdings and all that sort of stuff. But other central banks, they don't care. I'm mainly raising it because it's something that, as you say, economists, the financial press can use as a bit of a stick at times. So it was just to say, just ignore that if you hear those sort of headlines coming out.
Patrick is right. I mean, Patrick says could be a disaster with trying to unwind equity ETFs into a bad ending. That is correct, Patrick. But
Yeah.
are we there? That's the problem. Look at the topics. The topics is right now. I think we closed around, I don't know, 2,700, 2,750 or so. We're coming from much lower levels, right? We're coming from levels in 2020. This thing was trading at 1,400. But yeah, absolutely, we'll know possibly too late. But then, they all have the printing presses as well. So before really it gets to be a problem, we are absolutely nowhere near. I think the biggest issue right now, if Bank of Japan continues to raise rates, is the government. Is the government ready to fund the massive deficits or the massive funding stimulus packages? That is now the main question. And Bank of Japan is clearly buying them time to be ready for it. Okay, even if they're still a bit moaning at times, saying that, yeah, when yields will rise, it's going to cost us more. Well, I mean, UEDA has given them already a year and a half the time, or nearly 1.5 year, the time to prepare for it. So if they're not prepared for it, I mean, then they are no better than those regional banks in the US who were all of a sudden surprised that yields were going up. So yeah, I think Bank of Japan is giving them time to fund their stuff. So for the time being, I would say it's not tradable, this thing.
Yeah, and that goes the same for the pension firms that blew up over here in 2022 because they were caught with their pants down while rates went higher. And we saw what happened with that. Yeah, they should not be surprised over in Japan as to what's going to be coming. Right, over in New Zealand, we had a bit of price data out, quarterly PPI data, a little bit hotter. PPI input higher than expected at 0.7%, though slightly lower than last month. Output PPI up 0.9% as well. That's not such a bad thing if you look at it from a sort of margin perspective. Stuff that's going out is going out with higher prices than what it's coming in as. So, it keeps a bit of inflation pressure, but as I say, from a margin perspective, which is a very loose thing to take from that, but it's not all bad. Over at the Riksbank, Theden says that inflation is close to target and monetary policy is being adjusted with caution. And if the outlook for inflation holds, rate cut could be 2 more times during the second half of the year. So that CPI data that we got this week was a little bit mixed, but it doesn't seem to be changing the line for the Riksbank at the moment. Bank of England's Green was out in a bit of fence sitting from her, saying inflation persistence has waned since she joined the MPC last July. Thinks the burden of proof needs to lie in inflation persistence continuing to wane. Says data released ahead of our next meeting will give a clearer indication of how far along the last mile we have come. But then says need more signs of this waning persistence to vote for a cut. There's reasons to think the neutral level of rates has crept up and that a gradual path on interest rates is warranted. We've got some final CPI data from the Eurozone, nothing to write home about, all coming in unchanged. CPI confirmed for the second month on the trot, 2.4%. The core has come down 2 pips from last month. So we've got more inflation yet to come to see if we get close to that 2% ahead of the June meeting, this so-called done deal. ECB Centeno is doing a bit of a victory lap on inflation, saying that we're nearing the nearing of inflation to 2% is real. Inflation is falling and it's a sustained fall. Let's hope he doesn't get kicked up the arse in the next CPI reading. ECB's de Guindos says euro area wage growth is decelerating. And here's a comment I want to ask you about as well, Kay, because it just triggered something in the back of my mind. ECB's Nagel says that the 15 basis point spread between ECB rates might price out longer term money market transactions. And the reason what this triggered is there's been talk about bringing all their different rates in line. You've got the main refinancing rate, the deposit rate, and the marginal lending facility rate, which are all different rates. Is that something that might crop up in their June meeting? This talk about bringing it all into line, something I don't know the market is talking about.
No, it's very quiet around that subject, right? I think the market is purely focused now on what they actually will do with the main rates. I'm not so sure. And I would need to dig in a little bit deeper where Nagel sees a problem, a real problem occurring from bringing all those rates together. Is it going to do something with the bank reserves or those Basel requirements? I'm not too sure. I need to dig into that.
I think that specific comment was about all that tiering stuff that they've got going on, which is a bit different to aligning at their main rates.
But the tiering of what for as much as I followed all of these was more like to prevent people to really have to pay too many negative rates, right? That's what the tiering system was brought in for. They went negative, but then they put this tiering into place where the upper end of the highest tier was still 0 or even slightly, I think, if I recall well, was it 0.1% or so still, and then you had a bunch at 0%, and then only forced reserves, which were a lesser percentage of the reserves that banks needed to have in real negative territory. But SNB had that too, right? When SNB went into negative rates for so long, they also had a tiering system in place. But now that we are higher here, I'm not sure why he would view this as a problem to bring them all together, because that's really an issue when your rates are at 0 or negative, right?
Yeah. But I'm not suggesting it's going to be anything big, but it's, as I say, it just triggered something, the old conversation about it. And if it crops up in the ECB announcement or something, it might just catch the market on the hop. Not that I think it's going to be huge news. If they align rates, they align rates, and everyone just has to get on with it. But just say one of those things that you forget about, and then it might become relevant at some point. But anyway, we shall move on. We'll worry about that in June. Kestrel Kazakhs says conditions for a June rate cut are there. It would take a massive economic surprise for the ECB not to move. Says he's relatively comfortable with market pricing of rate cuts, and there's no need to disturb those expectations. Said cuts should be gradual, and it's easiest to move at quarterly meetings when projections are released. So he's trying to rule out a quick cut after the June one. Hawke Holtzman says the ECB must be sure CPI is on a path to target before cuts. So you can't take the hawk out of this man. He's been in line with the June cut, not much after that, and now he wants everyone to be 100% that they are in line to cut because the data says so. Right, now some important data yesterday from the US. Maybe not important in terms of size of data, but it was very important in terms of what the market did with it yesterday. We had, well, let's start. Jobless claims first. Everyone was looking at that after last week, and lo and behold, we're back down again. We've had a 13k drop in that, lower than expected. The 19k rise last week got the market all in a tizzy, and it didn't do that on the other side now. Housing data, building permits came in a little bit softer, down on last month, lower than expectations. Starts as well came in lower than expectations. It was higher than last month, but last month also got revised down, but still a miss on expectations. So a bit of a mix from there, but again, nothing horrendous. But those permits have started to tick down a bit. I think that's 2 months now of misses. So a pale yellow flag, let's call it that. Now, I think what took the market's attention was the import and export price index numbers, and particularly the import prices, which rose 1.1%, were only expected to rise 0.7% for year on year. Month on month, coming in a quite hot 0.9% versus 0.2% expected. That's an inflationary signal for the Fed, and not one that they'll be welcome with. Now, export prices dropped, which doesn't. It's only the import side that really affects inflation, rather than the export side. So, although there was a drop year on year there, month on month was higher. It's the import prices that are really more important for the Fed, because that shows that it's costing more for imports. Long story short, and that's not good at all. The Philly Fed was out as well, a little bit softer, but again, a little bit mixed numbers. The headline number was softer, business conditions softer. Capex, though, up a small pip to 20.10. Employment was less crappy. New orders were negative. Prices paid came down. So a little bit all over the shop. Overall, it still suggests a bit of weakness in manufacturing, but maybe some easing in price pressures, and employment or falls in employment are slowing a bit. Then we got industrial production after that as well, which was again a little bit on the soft side. IP coming in unchanged, was expected to rise a pip. Manufacturing coming in a negative 0.3, was expected to rise a pip. Capacity utilization largely unchanged, if you take away the revision. So on the whole, there was enough bad numbers in that across the different sectors, manufacturing, housing, etc., for the market to have another go at selling the dollar, but it didn't. So it was important, all this data, for see what the reaction was in the dollar. We didn't sell off to new lows in the dollar versus pairs like cable, Aussie, euro, whatnot. So now it looks like we may have run out of puff in those moves, because that data didn't trigger anything more. Doesn't mean we've finished. It just means the market might feel it's done enough for now, and it's going to take something more to get it going again. Conversely, it might start going the other way, but I don't think the market's going to drop this dollar negative bone just yet. Kay, what did you make of all the data?
A lot of hype for nothing. No, really. I mean, I think it is really that. I mean, if you look at all those numbers, take away the colors of the prints, right? The green, the red. Take away the colors of those prints, because the market always, or algos, or the market trying to react to the coloring of the prints. If you look at the housing data, for instance, the building permits still comfortably above that 1.3, 1.35 mark. Claims coming down a little bit. If you take away those, look how stable that number is, right?
Yeah.
This is a really stable actually market. If you look at the claims, we had that little blip, but look at that. I mean, it's a really stable market, right? So I think that's where the market got its surprise. Yes and no, but like, we know this market loves to sell dollars in general, but they didn't get like the complete green light. I would say though that the Philly Fed, even though it's a lesser important number, is keeping those yellowy flags. To me, it keeps them waving, and I really don't like. Usually, I don't like negative employment index, negative new orders, for instance. You know my opinion about the prices. I think we are gradually moving from an inflation to a real growth market. But we're still in Q2 and it's still going to be a mess. But yeah, I wasn't overly impressed. But then I think also, and that's what I've been saying on Face as well, and in the room. I think we've had like 1 week, a block of 1 week of data, and that block has been the block of data has been closed yesterday. Moves have been done. And then when we look at how the FX options are pricing this whole thing, there's absolutely zero nervosity in this market.
Yeah.
FX option vols are coming down, and that is just what it does. So again, take away those colors. It's still a soft landing scenario, right? So the equity markets are kind of holding up. There was no need to buy more bonds or to push yields lower, and so we are just stabilizing. So what does it mean? What it means is that if you look at overall at the dollar, yeah, the dollar has strengthened somewhat, but I think it's just a little bit of a give back of what we have done over the week. And you need flows to drive currencies, right? So I mean, if you don't have any extra flows to drive the euro dollar above 109, I mean, the result is that latecomers in this move are getting a bit tired, and we are now coming back to much more neutral levels. Aussie Kiwi a bit the same thing. They have been bought quite aggressively, but then we stalled at pretty important levels, and we're giving back a little bit of it all. This is how this whole 1 week block looks to me. And then you come out of it, and you still have soft landing stuff. You have like half green shoots elsewhere. And the result is that the low yielders are getting spanked again, and you look at the yen and the Swiss, and those are the ones still on the defensive, and that is typical for a market that like just zooms on, you know, with low FX volatility and everything. So I think now I'm not going to say that we always need to be or have to be positive. Oh, it's going to move, it's going to move. Yes, things are going to move, and things are actually moving. If you look at yen pairs and Swiss pairs, they are actually moving. But if you look at the majors, this is not a market that pushes me to put on hefty new positions, you know. I'm a little long dollars just because I thought the move was done, so I'm just smalls, long dollar CAD, small short euro dollar. I still got a bit of dollar Swiss as well, but I mean it's just a case of playing a bit of corrections perhaps, and watching those levels that held. I can show those levels in a bit, and then but I'm not looking for anything, any shocking moves coming out of the set of data that we had over the course of this whole 7-day block, you know.
Yeah, exactly. And you know, I said as much after the, you know, when we were making these, well, probably when we were around here, you know, after the data early this week, you know, don't chase dollar shorts up here. You know, we've come a long way. You don't want to find out that you're the one left holding the bag when the move runs out of puff. And you know, you've got to, this is why we monitor the levels, the levels that have got to break. You know, we've done a bit, you know, and cable I use, it's almost a picture perfect example, you know, at this 127, you know, we couldn't get through there. So that's your first indication, right? Something's happened. And then we get more data and we can't even get back there. So if you're at 126.50 and you're thinking, shit, I need to be on this train, it's high risk to do that, because you know how much more is it going to go, and you know it's easy to get sucked in. Oh yeah, we've had 250 pips moves, it might go another 200 pips, you know, don't want to miss out, you know, FOMO kicks in. But you've got to then, you know, match that off with what happens on the charts, what happens with the levels, and what the market does with the rest of the data. So as I said yesterday, the reaction over all that data was more important than the reaction over the CPI data, just to see what the market wanted to do with that now. Is it going to continue, or has it done enough. At the moment, it's done enough. So we're going to need to see something else. So you've got to be careful even if you're looking to dip buy in some of these pairs. We're on key levels. We'll look at these in more detail, but Aussie dollar, that break point that we spent weeks knocking our head on, couldn't get through many times, goes all the way back to when we broke down where it was support. So this is your level. If you want to try long, this is what you need to wait for, but you don't want to give it a lot of room. If you're below 66, 25, 30, this move is looking like a bit of a overextension, and we're going back in the box. And we know how that pendulum swings time and time again. It's done it all the way through. Dollars bearish, dollars bullish, dollars bearish, dollars bullish, all the way through. We've seen this picture 1,000 times. Don't get sucked into the hype just because you've seen a strong move. Use your charts to assign your risk and to tell the picture and tell the story for you. Anyway, we'll look at charts in a bit more detail shortly. Just get through some of the last speakers. We've had Williams, who doesn't see a need for a rate cut in the near term, says April CPI was a positive development for inflation dynamics. He says that the overall trend for slowing inflation still looks good, but still lacks the confidence that inflation is moving sustainably to 2%. He sees inflation in the low 2% range by the year end and around 2% next year. Fitz Barkin says companies are still saying there is no crime in trying to raise prices. He was speaking to CNBC. He says services in particular still feel they can raise prices. That's actually an important comment, because if firms still think they can put prices up, you're not going to see inflation coming down. It says the latest retail sales number point to good but not great consumer spending. Inflation is coming down, but it will take more time. Mester said that the current restrictive policy will help lower inflation and that monetary policy is well positioned as the Fed reviews more data. But risks to the inflation side of the Fed mandate have increased. Bostic pleased with inflation progress in April, i.e. the last report, but the Fed is not there yet. And he says it could be appropriate to reduce rates towards the year end. He's slid a bit in his timing over the last few months, and cuts. He only thinks we're going to get one cut. That's all on the news front, as far as I'm aware. Unless Kay's got anything extra.
No. Go ahead, my friend. Look at it. Look at your beautiful pictures.
Look at my pretty colouring charts. Look at that. There we go. Right, where should we go then? Just looked at Aussie dollar. As I said, it's a pretty similar story everywhere you want to look. We've done a lot. What's going to happen now? We had the zone. We had a little nibble above. Couldn't quite get up to tap the 109s. Now we're looking like we're, running out of puff a bit, and some air is coming out the tyres. Now we need to see where the support levels are coming in. If we're not going to go all the way back down into the old noise, then we need to see 108.30s, and then this area 107.90s, 108s, 10 down below, holding as well. If it does hold, then it keeps this move alive. And as I say, if you missed out on this trend, these are the areas you want to try it, but you don't need to risk a lot. No point putting your house on some of these levels. If they carve through, you don't need to be 50 pips offside before deciding that you're wrong. This one, dollar yen, I'm still not trading it. It's still just a popcorn show for me. We've come up and tapped 156, close enough this morning. The pressure's off. I think the Bank of Japan, they've sucked out the volatility a bit, okay, but we're still getting some quite hefty swings in it, but intervention risk waning a bit, I think.
Unless they view these 2.5 big figures as something special, but they have been relatively quiet. The intervention risk is always there, but I think it's they are going to run into the similar problems, and then if they would intervene now, it would perhaps look a little bit like a panic move. It's always a difficult call, but they are not used to intervene so regularly, one after the other, right? And unless it really springs back into their face, and well, of course, if you pop to 160 on the Monday opening, on the Monday open, they will likely intervene again, because that's just too fast.
Yeah.
But if I look at the whole picture, it's again one that I don't want to stand in front of this, because it's again not only dollar yen, but you look at stuff like all the yen crosses are up again as well. And I'm not going to say it's a completely lost fight, but I'm going to repeat that they missed an opportunity when the data came out and dollar yen went to 152. They could have pushed it below 150 and scared the speculators away. Now, I think those speculators are feeling very strong again. And any move back down to 152 will probably see a legion of bottom fishers again.
Yeah. And I just wanted to highlight, Powell is speaking on Sunday, which is going to be the early hours in Asia on Monday. Now, I've looked at his what it is. It's commencement remarks at the Georgetown Law Commencement Ceremony in Washington. I'm not sure that's going to be big for monetary policy, but he is speaking on Sunday afternoon in the States, which I said it'd be early hours in Asia. So just in case he does drop a bomb there, we could have some fun and games in markets after that, but just something to be aware of. Couple of pairs I want to look at just before I hand it over to Kay. Just a couple. One I'm getting a bit nervous about, and that's dollar CAD. I've been happy to look for longs down in this 136 area, but I'm not at the moment, because I think it's looking a bit creaky, if you ask me. We're struggling around this area, 36.50, 36.30s. We need to get back above and hold above this 30s and then 50s, or I think we might be heading a bit lower. Got this support just sub 136, 135, 85, 90. So I think that's your marker from here, 136.50 to 135.85. If we bust that, I think we're heading a bit lower. Don't know how far. We've got level 35.50, but if it is a bit of a decent break, we might be heading down to 135, which is another decent area. But we're getting these lower highs, and it's really struggling to get off the floor. So it's going to need a bit of a turnaround. But as we say, a level is a level until it's not. So, it doesn't mean it's definitely going to break. But it's just price action saying it's looking a bit weaker than it was before. And dollar MEX is one I'm looking at for a potential breakdown of this support zone. This was a big old support zone when we came down, in this move here. See, it's a prior support zone as well. So we held it, had a big old rally. We've come down, then we had a decent break. We're on it again. And again, it's another one that bounces are looking fairly weak at the moment. It's suggesting that we can't get off the floor. And if that happens for long enough, then we're potentially getting a break. So I'm in with some sell stops just to give that a little go if it happens, and see if we get another move down towards those 1620s lows. Kay, over to you, mate. You can finish us off for Friday.
Okay, where's my share screen here? Here. So first of all, and this is just to highlight the move that we have seen, which really overlays pretty well with what's happened on the in the dollar over the course of the week. Okay, and I've highlighted this zone before. This is around the 435 in the US 10s. We're looking at the US 10s. So again, we can see here. So these are prior low, prior high, prior high, prior high. Then we try to break, bounce, break, bounce, break, and what do we see? Bounce again. And this is exactly what we are seeing right now in the dollar again, right? Trying to break this 435 zone on the US 10s, and we are gradually creeping up again. I'm not saying the dollar is going to fly, but far from it. But it's just another bit of a show to tell you that it doesn't have to always break and go, you know. I think there's a lot of fake stuff in fakey breakies, like they say. But once the bond market has finished doing its thing, the yields just go back to where we were. I would call this a relatively neutral zone here right now in the US 10s. And well, one can look at the differentials. I always look at the differentials, but the differentials are not giving me too much of a hint right now, because they are living their own lives a little bit, because people are trying to price the ECB, trying to price the Bank of England. So the differentials are a little distorted. Well, I think anyway, right now I don't see too much of a message from it. And we had similar on the twos, right? This week. So this is around the 2.5 cuts expectations, but we have been turning around, trying to break, bounce, trying to break, and again this week trying to break, and then we're bouncing. I'm not expecting that to see this thing go all the way back up. Not right now, because we don't have the data to support it, and I guess the market is just like getting back in the middle, done its thing, and now we are in a wait and see. So I expect this to be a bit rangy. Probably similar thing in the US majors. Um, and majors, I'm talking about stuff like the euro dollar and cable, perhaps amongst a few others. So this just to highlight what I've been saying. This 1 week block of data, and this seems to be coming to an end. This rebalancing, right? Okay. Current size. Yeah, the first I want to look at, because Ryan is looking at dollar mix. I'm still a bit short euro mix that I've entered again around here. Already bought some back, but it seems we're again, the laws of gravity are doing its work again. Laws of gravity meaning it's still an 11% currency, the Mexican peso, and when there is not too much reason to sell it anymore, or scary blips and things, it does seem that the MEX is still a wanted currency. The data in the US, because it's the biggest trading partner, of course, are showing a little bit of flags, but nothing really red. So I think this one, we could come and rest on those supports here towards the end of the week, where I'll be happy taking profit on some parts. And today, and I'm usually not really showing too much of the of S&P myself, but today we have OPEX, if I'm not mistaken. So take it into account. This could get a little bit wobbly, and then look where we are towards the close of the day, start of Monday open. So I would say that keep an eye on the 52.80, below there 52.65-ish, but then especially I would say 52.40. Okay, if OPEX would be that side, I have no clue where OPEX is going to take us today, but what I do see is on OPEX days and blips and whatever. Once the dust settles, we just continue to do what we were doing before. So in this case, come Monday, if OPEX put it lower, perhaps the opportunity fishers will line up anywhere between 52.40 and I would say 5200, 5180. But that would already be a big move. If there's nothing dramatic going on, and we would continue to move higher, I would tell you to keep an eye on what's happening at 53.70.80. Those are extension levels of the setbacks that we have seen here, and the one before as well, the bigger one. 53.70.80, I think, are going to be important enough to watch on the top side of the S&P. Okay. And then keep an eye on, of course, on my Swiss positions. Euro Swiss finally started to move again. We're going up. I'm still smalls long. We're coming into a bit of a zone here around 98.85 up to 99.15. That's going to be the gateway to parity for the Euro Swiss. And then if that would continue to go, Then we are going to have to look at the much longer term, which comes in at around 101 here as well. That's where we started from. This is also one of those moments where the SNB said that they would buy Swiss franc to combat inflation. If ever it comes up to here, I'm going to be a very happy take profit and just watch the game. Okay. For now, I'm continuing to be long. Sterling Swiss, we are now finally reaching this very, very, very important block. Okay. And this is going to stretch from 115.10-ish. We are really very close to it now. Look at those tops here, all the way to 115.75. That is just those tops here, okay, and the traffic zone. But then we are going also to have the longer term trend line coming in. That's around 116.20. And then we have tops and bottoms here around 116.80-85. So the next, that's for the longer term, okay? The next 200 points here in sterling Swiss are going to be of huge importance for the long term. I am still a bit long of it. I think we are going to get there eventually, but I'm slowly but surely starting to look at the sterling side because I'm not nervous about it. The market will do what it likes, but there is that just the possibility that the market is going to price in earlier Bank of England cuts, and I'm going to just keep an interested ear to what the market is saying about the Bank of England, because that, of course, is going to influence the sterling Swiss. And then I'm coming back, and I see the time, Ryan, and don't worry, I'm going to keep it extremely short. But then when you look at fundamentals, and I was talking about those low FX volatility, FX vols, okay? Low FX vols are usually pretty okay for what we call risk in general. And sterling being a risk currency is usually okay in a normal correlation dynamic for what sterling is concerned. And the Swiss being now a low yielder since SNB started to cut their interest rates, that is what we are now seeing mechanically actually driven by low FX volatility. Same can be said about the MEX. High yielders normally thrive in a very low FX volatility environment. Okay, so this is a little bit of an insight on what can happen on risk, even when the markets are extremely quiet. Usually, high yielders fare pretty well versus the low yielders, and that's exactly what we are seeing actually on the yen as well. And with that, Ryan, I'm gonna give it back to you. And hey, Ryan, why don't we review Bitcoin and Ethereum? Those are not currencies, Ali. That's just a game. Just a game. Yeah, back.
Thank you very much, mate. Yeah, I'm just replying to Ali. Just quickly, Ali, you can trade what you want. Doesn't matter. Cryptos, oil, commodities, Forex, pigs, orange juice, wind, weather, whatever you want. Doesn't matter. If you learn to trade well and understand markets, you can trade anything. Okay, it doesn't matter what the asset is. So don't get caught in the hype. Learn to trade well and properly first, because once you do that, you can trade anything that's got a price that goes up and down, because that's what matters, how you trade it, not what the asset is. But anyway, that's the last thought on crypto. Yes, Saeed, you can trade the weather, mate. There are weather futures which are used by people who have soft commodities. You can trade anything in this world, mate. And on that note, thank you once again for coming to the Flow Show this week. Thank you, K-Man, for all your valued insight as usual. Have a great rest of the day. Have a great weekend, and we'll catch you all on Monday. Have a good one.
Hey traders, this is Blake Morrow with ForexAnalytix. Thanks for stopping by our YouTube channel. Don't forget to like these videos, share them, and subscribe to our channel so you don't miss any of the content that we provide here for free. Thanks for stopping by. I'll see you in the next video.